your face right behind the microphone.
Is the market accurately pricing risk? Hi, everyone. Welcome to the Market House. I'm Maggie Lake, and today I'm talking markets with Phil Dauber, the author of the Substack Thoughts from Dauber Island. Phil brings a wealth of experience to the effort, having worked as a financial sector trader for 30 years, a sales trader who's done the rounds at Lehman, Bear Stearns, JP Morgan, to name a few. So we're lucky to have him today. Hi, Phil.
Hi, Maggie. Nice to be here.
It's great to have you. Hey,
I think I'm supposed to say first time, long time with this.
Yes, maybe. But we're super excited to have you, and we already have your fans in the chat. Tommy Thornton, hi Tommy, said Phil is awesome. So fun fact, Phil goes way back with some of the folks that you see on this program. Tommy Thornton being one of them, Jared Dilling being another one. All these sort of really experienced traders tend to stay together and talk to each other all the time. And so we're super lucky that we get a little peek inside that world today. So let's start with the market reaction. We've been talking a little bit over email, but I mean, by the way, we couldn't have planned this better. I mean, talk about, sent me a message saying, oh, we have nothing to talk about today, because obviously we arranged this a while ago. And then of course we all woke up over the weekend to news of the U.S.-Israeli military strike on Iran. We watched the action unfold today, and oil retraced almost half of its upside move. Stocks rebounded after an early sell-off. What do you make of the action you saw?
Well, there's a couple of things. There's so much uncertainty right now. I'm not surprised that we saw some kind of reaction. You had the early nervous hands of the people who are badly positioned unwinding, with alacrity, or, some of the risk models all of a sudden say, sell your silver, buy oil. Mm. And then as, in uncertain markets, you'll see the markets often trade I find they trade to technical resistance and support levels. So like the E-minis got back to unchanged on the day and then rolled over again because, everybody had done what they wanted to do. It didn't really get going. And it's like, okay, let's flatten our positions when we're going home. Oil, obviously, there's a reason for it. I think nat gas is worse. If you look at some of the European nat gas futures, I think the Dutch 1 month forward was up 35%. I mean, there's a real concern about natural gas. I think the gold sell-off early was just people using liquid positions to raise liquidity and buy things. We talked a little bit about the bonds. The bond reaction I thought was perfectly normal because you have higher crude. Crude is probably the biggest input into inflation concerns. You had strong economic numbers today. Plus, you have crude, which probably doesn't go back down to 60 for a while, unless we have an incredible regime change in a week or two and everything's reopened. But this is we're talking 4 or 5 weeks of bombings and regime change, and it's certainly a lot of uncertainty. So I'm not surprised that the bonds backed off a bit.
Yeah. So I think, first of all, I just want to jump on the one comment you made, which is really interesting because we've had a lot of gold bulls on. We're talking a lot about gold. I've been spending a lot of time in the hard asset community, having a lot of conversations. And you just said something, which is they sold gold because they wanted to raise liquidity. That's the other side of gold, right? There's this really strong argument for gold. But in times of stress or risk, people will sell their winners to try to raise capital. Like that's been left out of the conversation lately.
Well, it's not, winners for sure, but it's also the most liquid assets. So if you have a problem in credit, private credit, which we could talk about, people will have to raise liquidity by selling equities or selling, futures, selling bonds. That's where you'll see some of the moves in the other assets. It's not necessarily contagion. It's just, I need to raise money fast.
Right.
How can I do it?
Yeah.
And then you have that domino effect.
So how do you sense the rest of the week plays out here? What are people going to be watching for? I know, give us your crystal ball, but I mean, what will you be watching for? What markets matter or will indicate to you whether people are going to have to build in some more risk premium or whether they've kind of moved on? Because there's this knee-jerk fade the geopolitical event, right? You see that all over X today. That's kind of the playbook. Does it feel like that's what's going to happen again? Or what will you be watching to see that maybe not so fast? Maybe there's a little bit more concern.
It's interesting. There's a couple of things that I think are different about the markets these days. And I'm going to talk like a dinosaur, but there's so much short-term volatility that you have kind of chased out or sidelined a lot of the long-term players. Because if you look at the S&P, it's been in a very tight range for 3 months, even though we've had crazy intraday moves. But we're up or down 3% over the last 3 months. If I'm a long-term portfolio manager at a big mutual fund, I may not be changing my positions by that much. There would be one-off stocks, but I may not be unwinding and winding. So you have a lot of short-term traders. You have a lot of the platform pod hedge funds that have tight risk parameters. If the value at risk, if the famous VAR measure changes intraday, they get told that they have to unwind things. So what happens is, and because of the internet, and nobody watched Twitter until 2011 when John Boehner famously walked out of his meeting with Obama and tweeted that there was no debt ceiling deal. And all of us sitting, on desks without Twitter couldn't understand why the market absolutely collapsed. Well, he tweeted it. So now everybody has to watch Twitter, and everybody's looking at every other, news aggregator. So we're reacting to everything. Any Bloomberg read headline, markets move. Maybe wrong, because everybody wants to be the first to announce the news. So so it gets difficult. The signal to noise ratio, I think, is as bad as it's ever been. The other thing I would say
is that's really important, because then we're like, if that's the case, then how do people figure out, or what should they be watching if they're not getting an accurate read from the market? Because it used to be the market is the truth, right? But it sounds like that's not the case anymore.
Well, I think you have to zoom out. I think we all stare at our Bloomberg screens, and if you're looking at a 5-day chart, it looks like it moved a lot. But if you look at a 1-year chart, it really didn't. And I think that's why you have some of the longer term targeted players saying, hey, you know what? My basic thesis is still correct. Like, we're going to have slow growth. Inflation's going to stick around. It's going to be, 2.8, 3.1. Fed's going to move a little bit. Maybe you get 25 bips. Maybe you don't. I don't need to really adjust my portfolio dramatically. We're kind of is it slightly stagflationary? Maybe. But it's not, we're not in a big recession. We're not seeing hyper in inflation. So I think you need to have a thesis, and you have to, the old, John Maynard Keynes, when the facts change, so do I. You have to be willing to say, hey, these are the 3 or 4 cornerstones of what I think. If one of them changes, I now have to re-rack the balls and say, all right, let me look at it again. But if they don't, you have to kind of just ride it out a little bit.
It's
the other
interesting.
thing I was just saying, the other thing that's going on in this market is, I would say, about to guess, 30 to 40% of the people, of the traders in the market now, certainly weren't around in 2008. So since, aside from COVID, buy the dip has worked every time. So today, market, I walked in this morning, the S&P futures were down 73. That's meaningful. By the time the market opened, they were down 50. And it's like, oh, well, down 50, you buy them. The software ETF, it reached support. Oh, we have to buy it now. Now, again, we had the overreaction because AI was ending the world tomorrow and Skynet was taking over, or whatever. Everybody was going to lose their job by next Tuesday. Whatever. We get a little crazy these days. But a lot of it is buy the dip. Oh, it's on support. Of course, it's going to go up. And it gets a little self-fulfilling, because you have a couple of people do that, and everybody says, "Uh-oh, I'm missing it," and runs back in. So in terms of, I will tell you, I sit here and I've spoken to other people. I've spoken to Tommy about it. It's such a fire hose of information, and markets are so interconnected now. It's really hard to figure out who, what, where, and how. It is as hard as it's been since I've been in the business.
Well, if it's hard for you guys, God help the rest of us, because as you said, there are people with a lot less experience, but who have the access that, only used to happen if you were on a bank trading floor. Everybody thinks they're trading. They are trading on their
Right.
phones from wherever they are,
Right.
24/7 in some cases if you're in crypto. So does it feel like, are you saying that buy the dip is that is may not work soon? Do you sense that that's come to an end?
It always comes to an end. I mean, it's one of the, it's like technical analysis. It works until it doesn't.
Mm.
A level is a support level until whatever it is, whatever asset breaks down, and then it's resistance. Yeah, well, buy the dip will work. There's a lot of money chasing it. But the problem is if it fails, you trap a lot of people and it accelerates, and I think that's one of the worries. Mike Green famously, has been talking for, I don't know, 10 years about passive. And passive helps buy the dip because they will add to their big holdings. But if passive flows ever reverse, it's going to be a fire drill getting out of the positions.
I think that's what so many people worry about.
Right. I mean, if you look at the skew, so if you look at the difference between the premium you're paying for puts versus calls, people are paying more for puts, which means they're buying insurance. And even as the market's been going up, the skew has stayed pretty steep because people are nervous. It's like, okay, I need some disaster insurance. Like, I hate to say it, but I started trading in 87. So I watched portfolio insurance basically end people's, careers because they were sure the market would never go down like that. It doesn't happen. Home prices never go down until they did. Right. So that's the problem. And you always bought builder stock. You always bought financials because credit would never crash. It just doesn't happen. And I was a bear in 08, and I will tell you that the guys trading MBS and ABS were sure everything was fine. 5 days before bear got shut down, they thought we were fine because that 2 standard deviation, that disaster move, the chances of that are 0.05% or whatever. So it won't happen. Sometimes it happens.
A lot of people think back then it was just the Fed saying things like that, but that's not the case. There were people who were, inside, as you say, on those trading desks who were just as shocked.
They were probably more bullish. And these are the people who should have known better, who maybe, look, there's FOMO, right? You don't want to miss a trade.
Yeah.
So you may be nervous, but if that's the trade that's making everybody money, you can't miss it. And
well, there's a lot of that's been going on, right? This is the whole AI. This is what has, I think, people so worried, the herd mentality that's been around Mag 7, all things tech, all things AI. You mentioned before, it feels like that's reverse. A lot of people saying, oh, software stocks, it's run its course. They put their lows in. Does it feel like that's the case, or is this round one in that argument about the direction?
I think we don't know, and I think that's the concern, right? So everybody thought AI was going to be great, but we had a few years until it would really start competing for white collar jobs. And then Claude rolled out a couple of new modules, and everybody had to do their math again and say, 30% of jobs in 3 years. What does that mean for every software company? What does that mean for every financial technology company? If so they rolled out the lawyer module, and all the services companies went down. Then they rolled out the financial model, and all the brokers went down. And this is an example of why it's hard to trade this market. With all due respect to Citrini, and he does great work, but he's a guy who wrote a 30-page article. And he took billions of dollars out of the market, out of a 10-year, this could happen paper. He doesn't have some insight. He doesn't have a crystal ball. He's not from the future. But they took stock. I mean, IBM was down 12%. This is IBM.
Because 12%. I think it spoke to the fears that everyone has. It just articulated the fears that were out there.
Right. But it gets overdone. So again, if you have quantitative, algorithmic, mechanical trading strategies, or you're a retail investor and you look and you see your IBM is down 5%. Oh no, I better sell some.
Yeah.
And all these mechanical systems, all of a sudden there's more value. It's a 3 standard deviation move. My formula says I have to lighten up by 7%. And they're price agnostic. They just need to sell it or just need to buy it. It feeds on itself.
It does. We've seen that, right? We've seen that. We saw the bank run on Silicon Valley. Like everything is instantaneous, and then people ask questions later, which I think is what everyone's worried about. That's the sort of volatility that it's like churning and nothing's happening until the bottom falls out. But is that just sort of fear-based thinking, and the long arm of the financial crisis still kind of wreaking havoc with people's psychology? Like we're always waiting for a disaster.
I mean, there's probably some of that. Generals always fight the last war.
Yeah.
I think. Look, I think performance metrics are shorter and shorter term now. Like if you're a fund of funds guy, you're looking at where you allocated on a quarterly basis, sometimes even a monthly basis. I know that places like Citadel have very tight stops on their risk exposure. So you can't wait to see if it's overdone. You have to react. I will tell you, in during COVID, the bank stocks obviously got annihilated. And I know a lot of financial portfolio managers who were very nervous. But passive had started to buy the banks in June of 2020. These guys got dragged kicking and screaming back into the investments because they were being told, the big secret is it's not an absolute performance game for most of the investment institutions. It's a relative performance game. It's the old joke about two guys chased by a bear and they're running, and one guy says to the other, "Why are you running? You're never going to outrun the bear." And he says, "Oh, I only have to outrun you." That's what's going on. You just have to outperform your peers, and you raise more assets. More assets is more, locked in 2 and 20 fees. That's the big game. Collect assets. So it's a lot of looking over at your neighbor's positions and saying, "Oh, I have to get kind of close to it. I can't be too variable." If NVIDIA is going up, I have to own some NVIDIA because otherwise, there were years that if you didn't own Apple, you were underperforming. Full stop. You lost. End of the year, you lost assets.
Yeah.
Whether or not you were a growth manager or not, if you didn't own Apple, you had a problem.
So I think this is really important because people think that people are making sort of fundamental and technical decisions and doing all the due diligence, and there's some of that happening, but a lot of this is just driven by market dynamics itself, which is I think a little bit of a scary setup.
Again, an apocryphal story that Steve Cohen, when asked about investing, once said it's 1/3 macro, 1/3 the asset class, and 1/3 the sector. I would argue that probably now it's much more macro. It's things like AI. It's things like tariffs. Obviously, things like the Middle East right now. And that kind of sets the entire framework for what you're doing. Now, again, we could talk about Iran. There are people who think this is short term. Iran's going to cave. We're going to have, whatever the internal result is in Iran, you'll have a safer Middle East. Oil won't get disrupted. Well, then you'll invest in a certain way. And there are others who think this is going to be long term. The Iranians will never give in. They're religious zealots, however they want to phrase it. And they're going to invest a different way. Back to what you said, I think that's why you see some of the portfolio managers and some of the, the old school, what we call the vanilla mutual funds. They're not doing a lot because, again, the fundamentals haven't changed that much. Unless you think it's a tectonic shift in the framework, you tweak, but you're not really making moves. So a lot of this is a lot of guys chasing the next best thing, which could be a day, could be a week, could be a month. It's probably not 6 months.
Yeah. Short-termism.
Right.
It's interesting in the midst of this big rebound today, and everything kind of settling down and rolling off the initial reaction. Jamie Dimon, who's not mincing words these days, came out and said he expects terror attacks and cyber attacks as retaliation. Now, is the market too complacent about that possibility, or is it just impossible to price those kinds of risks?
Personally, and I have been accused of being Debbie Downer, market is too complacent. I do not think that the Iranians have done everything they can or will do to retaliate. Now, I would bet that there have been cyber attacks and that we were ready for them, and that there's a whole cyber war going on that maybe we'll hear about, maybe we won't. But could there be terror attacks? It's certainly a non-zero possibility. And again, if we wake up tomorrow morning and a car bomb went off in France, market's going to be down a bunch.
Yeah.
So yeah,
the headline risk. It's got to be headline risk.
The market hates uncertainty. More than anything else, the market hates uncertainty. And I think, that's one of the issues right now with the Iran military action, or whatever we're calling it, is it's unclear what the goals are. The president had 3 phone interviews and gave 3 different goals. One was regime change, one was internal revolution there, one was we want to make a deal. It could be that they're just playing it by ear in terms of, if Iran is willing to concede what we need them to concede, then we'll be it could be, but I think that was probably the hardest part about tariffs, is they changed every 2 weeks.
And now this is back to a situation where it's unclear, what the plan is or the parameters are, and what how to judge what, I guess, sort of success or progress looks like. What you mentioned to me, and your latest Substack has a big old picture of a cockroach on it, sort of echoing Jamie Dimon's other warning from a few weeks ago, that there's never just one cockroach. Private credit, it's kind of been bubbling. It felt like it was becoming more front of mind for the market before we had the war sort of wipe it out of the headlines. Are the issues in private credit, do they have the potential to be systemic? Is that something you're concerned about, or can it stay ring fenced within private credit?
I think it's a huge deal. And again, this is, I'm having muscle memory. This feels a little bit 07, 08-ish to me. And the reason I say that is the best story is, so Blue Owl, which has been a poster child for potential problems, they sold a bunch of private credit to a consortium for 99.5 cents on the dollar and trumpeted it. That it was a big deal. Well, what they didn't tell you, that was one of the buyers was one of their subsidiaries. So first of all, but there were a couple of distressed funds, Boaz Weinstein Fund, Saba Capital is one of them, who went into Blue Owl and said, we'll buy your credit at 70 cents on the dollar. Well, what is the credit worth? The problem with a lot of this credit, and this is the same thing with the CLOs and the CDOs back, is because they're illiquid markets, you don't know what the right price is. And you can't market to market, you market to model. And the model is subject to whatever parameters you put in the model. So when JP Morgan took over Bear, they found that some of the assets that Bear had marked at 90 cents, they were selling for 30 cents. Well, they never traded. So there was no last sale. So they bought them, they put them on the books, and they said, yeah, 90 cents sounds good. Well, we're seeing a lot of that in private credit. Plus, we're seeing fraud. Some of that seems to be, I don't want to say laziness, but not as much due diligence as, to me, on the outside would seem to be called for. Where First Brands, Tricolor, now MFS, they pledge the same assets to multiple lenders. I'm not sure how that happens.
Yeah, accidentally. That's like,
no,
that's not a super.
Right, but it's caveat emptor, right? If you're going to lend someone money, you should make sure that the asset is unencumbered. And for some reason, it's happened to the tune of billions of dollars.
So it's interesting when you make the comparison, and this is, I think, the exercise that everyone's thinking about, because in addition to they're illiquid, so you don't really know what the value is. So obviously, in a bullish market or frothy market, everyone is going to assume it's higher, and then the reality of that hits home, and you've actually got to do price discovery. Not unlike the valuations for private companies that are sky high, and then they IPO, and then you find out what people are really willing to pay for them, right? That's why IPOs are interesting. But the other issue I'm wondering about is, back in 2008, when we were talking about the collateralized loan obligations, the collateralized debt obligations, one of the things that came out during that time and all of those other MBS was that the sort of opaque nature of counterparty risk. All sorts of institutions had these things on their books. And they didn't even know. They didn't appear to know. They didn't know what they were made of. It was unclear whether they even understood what the instruments were. It was rife throughout all these European banks. And, how would they be exposed to the U.S. housing market? Well, it turns out that they all had these sort of, complex financial instruments on their balance sheets. Is there any risk that is also the case, or is that in that sense, are these things within the private credit market only? Are these on pension balance sheets and insurance balance sheets now that everyone's been trying to get into the private market?
Oh, yes, they are. Well, look, in each one of these private credit blowups, banks have lost a lot of money. Jefferies has lost money on every one of them. Wells Fargo has lost money on every one of them. JP Morgan lost a bunch of money on First Brands. There are a lot of banks involved, and I'm not as well versed on this. I'm still trying to get, but I know people who have done a lot of due diligence on it. The life insurance companies have major exposure to private credit. And this is, look, it's similar to a lot of what happened in 2008 in the sense of life insurance companies, banks investing, they're looking for a high return.
Yeah, it's the chase for yields,
right?
That's what gets everyone in trouble.
Right. So it's the same thing now where you seemingly are getting good yield. I don't know why and how there's not a better ability to price the assets realistically to see what they're worth, to see what your principal risk is. But you're a life insurance company and you need to make, 6% because of all
cover your liabilities, right?
Right. Okay, so you're looking for 6%. You're not getting 6%, so you have to start going out the yield curve. Why are high yield spreads so tight? Same story. It's the same trade.
So can this extend and pretend as long as people don't have to mark to market? I mean, I guess that's the,
Yes.
Yes.
I mean, it's not Greece sovereign debt, but commercial real estate's another one. There's a lot of commercial real estate coming due in this year because it was 5-year commercial real estate loans, a 5-year paper. 2021, there's a ton of new building going on, new construction. All that is coming due this year. It's a huge number. And commercial real estate has not recovered. We're all working from home sometimes. Vacancy rates are still high. That was the Silicon Valley. Silicon Valley was a one-off story and First Republic, but Signature Bank collapsed because they had all these unrealized losses on their books that they never had to take. It was treasuries at that point because the Fed had really, really encouraged banks to buy a lot of treasuries. But the unrealized losses in banks right now is still something in the $300 billion number.
Yeah. I guess if everyone's naked, no one wants to turn on the light, though, right? Like if everyone's holding the bag, then there's no. It's in everyone's interest to keep kind of rolling it until the market. What would be the trigger? Yeah.
Well, the trigger is when it's not look. New Century Financial went bust in early 2007, mid 2007. It didn't get really bad until January, February of 2008.
Yeah.
So there's time. Look, what you have to know, to give you an example of what you're asking, is all these private equity companies and these other groups, they're called non-depository financial institutions, right? NDFI. Banks were lending money to them, but filing them as commercial and industrial loans.
Mm.
So beginning of 2025, the commercial industrial, the C&I number was really high. Over the last few quarters, the FDIC has come in and made the banks recategorize them as NDFI loans. Because as they found, they were like, that's not a commercial loan. You're lending it to a private equity company. You're not lending it to the end user. You're lending it to the intermediary. And so, multiple million, hundreds of millions of dollars have been recategorized in the last 6 months. It's a big number. And again, I'm sure a lot of the loans are fine, assuming there's no fraud in the double collateralization.
Yeah.
But there are going to be some that are going to blow up.
Yeah. And it's always at the intersection of things, right? Like in and of itself, maybe they can kind of work it out. But then if you have other dislocations in other markets, this is when it gets a little bit, I think it gets a little bit tricky.
Leverage.
And leverage, right.
Private equity companies are using 10, 20 times leverage. So it doesn't take a lot for them to have money problems. Like, look, AES today got taken over. AES would have had to cut the dividend dramatically and issue a ton of stock. So they got taken over at 15 off a 17.5 last sale. Shareholders lost, 10, 15% just because the company said, oh, we can't do this because the financials were just too levered.
Yeah.
And there'll be more of those.
Yeah. So it sounds like you're pretty cautious in this environment. Is that fair to say, Phil?
Yeah, but it can take a while, right? So it's hard to be cautious when the market goes up every day. So putting Iran aside, the market has been up and to the right, for a while. Was it up 15% versus 10%? Do you have to be in the right sector? But liquidity and inflows of money trump everything. And right now, money's coming into the equity market. Yeah. 401ks are still flush. I'm not sure what the story is going to be with crypto. Crypto was an alternative. Bitcoin was the alternative to equities, but it's kind of turned into, just a risk-on asset as opposed to, the alternative to gold, which people push. Now, long-term, crypto, I think, is a real thing. But is Bitcoin a real thing? I don't know what Bitcoin is worth. I tell people I think Bitcoin is Netscape.
What's the technology? Not sure about the
double bookkeeping. The blockchain technology I think is great, but is it Bitcoin? I don't know.
Yeah,
that's a big bet. There are ways you can play it, but that's the most liquid one. That's the popular one, and everybody talks about Bitcoin. You get in a cab and they want to talk about Bitcoin. So,
well, not so much recently, except when's it going to turn, right? Like, as it's been so weak, but.
Right. Unless you're Mike Saylor at MicroStrategy.
Yeah, he talks about it every day. I see on X. Listen, I think this is so interesting, and I'm going to thread together for those who watch all the time. Whenever we have two things that other people have a lot of market experience have both talked about, which is sometimes doing nothing. Those who are long, they're not going to change every single day. There's a lot of short-termism in the market. You remember Corvin saying, you got to sort of block that out. And we just had Jim Welsh on too, who also was talking about you can have concerns, but that doesn't mean you sell stocks necessarily. So you have to kind of look at the performance. You have to put your concerns about the risks and then weigh that on what's happening with the price action, which it sounds like you're saying, Phil. You can't ignore a market that's going up, even if you have concerns.
And that's why you'll see people playing the options market to get some protection, or if it's a 10% position, maybe you cut it to an 8% position. You take a little bit of risk off the table, play with the house money.
Yeah.
But look, it always makes sense to me to have some kind of downside protection, whether it's downside stops or an option position where when you get to your pain level, you've already built in the fire escape.
Builds in the fire escape. I absolutely love that idea, and something that we should all, like, a visual that we can all get behind. Phil, this was so much fun. People want to see more of you. Where have you been all their lives? They're asking. But Tommy's been explaining in the chat that you were prohibited for a long time for talkings, but we're happy you're out. Loose in the wild now. Able to
and let me say, Maggie, by the way, that I am working at BGC now, and this does not, nothing I said represents the opinions of BGC. This is all me. There's no investment advice.
As Substack author, and nothing's financial advice that we talk about either. We tell people that all the time, but our audience knows that. But really great stuff, Phil. I'm so glad you could join us. We hope you'll come back. If you're not subscribing to both of our Substacks, please do that. Phil shares the note that he puts out on Bloomberg, so you can see it too if you go to his Substack. It's awesome and keeps you abreast of everything that's going on. And I just put a reporter's notebook out, folks, of sort of summing up a lot of the chats I've had over the last month and some of the things that I'm thinking about and pulling forward into March. So make sure you check that out. Phil, we'll talk soon. Thank you.
Thank you, Maggie. This is
Have a great week, everybody. Take care and good luck out there. And we talk a lot about war and passing as a market thing, but obviously, if you're in any way affected by this, we know there's a lot that's happening in the region, or if you have loved ones that are over there or serving in the military, our thoughts are with you. This is really serious stuff, and we never mean to just sort of, talk about it in light terms. But there's a difference between talking about it as an issue and talking about it in terms of market reaction. But we hope you understand that. So hope everybody's well. We'll see you again Wednesday. Bye.
Thanks, Beck.